Today, we welcome to Kiamidis Money Honey, Clive Moore, founder and managing director of IDAD, specialist in structured products who came from London in order to discuss in depth the issues involved with this method of investments. Topics to be examined will be: what makes structured products different? They don't break the rule higher reward means greater risk, but they skew it in favor of investor. Positive returns in all types of markets. Tightening return range increases probability of meeting desired outcome. How is pricing done? The presentation is for information only and does not constitute invitation to invest. Καλωσορίζουμε στο Kiamidis Money Honey τον Clive Moore, ιδρυτή και διευθύνων σύμβουλο της IDAD, για να αναλυθούν σημαντικές πτυχές των δομημένων επενδυτικών προϊόντων. Ποια η διαφορά τους από τις άλλες επενδύσεις, γιατί αποδίδουν και στις ανόδους και στις πτώσεις των αγορών, τι καθορίζει την απόδοση, γιατί αποφεύγεται ο κανόνας ψηλότερη απόδοση σημαίνει ψηλότερο κίνδυνο. Η παρουσίαση είναι μόνο για πληροφόρηση και δεν αποτελεί πρόσκληση για επένδυση.
Γεια σας. My guest today is Clive Moore, who came from London. For the 8th podcast, he was on the first podcast, again from London, on structure notes. He is the expert and the founder of IDAD, specialist in investing in structured products. Welcome again, all the way from the UK to the European Union. Thank you very much.
Yes, and thank you, Mr. Kiamidis, for having me back. I can't believe it was 18 months ago we did the first podcast.
Yes.
So it's a pleasure to be back in Cyprus.
There is such a thing as public demand, so a lot of people requested further information on structure notes, which we hope to deliver today. In a market that has now become volatile, it has been going up for the last few months. We know there is quantitative easing, so the chances are it will continue to go up, but there are upheavals. So please, what makes a structured product different from other investments? Why is it that people are showing so much interest? I mean, I know you started more than 25 years ago, and other people are doing them, but there are structure notes and structure notes. I know you use mostly indices, important indices, which do not collapse, whereas an individual share could collapse. And I know you have contacts with 50 at least premium banks from which you get quotations. So let's try and take it step by step. What makes a structured product different?
Yeah, thank you, Kostas. I guess, and in fact it's 33 years since I did my first structured product. And we set up the business IDAD in 2002. One of the key things I wanted to achieve in particular was a lot of the financial services world is designed to use the greater knowledge and experience and expertise to deliver benefits for the bank or the insurance company that's delivering the products. What we set out to do at IDAD is to use our expertise and experience, and there's 50 of us now, a lot of people with a lot of experience working for banks, insurance companies, was to use that expertise to deliver benefits for the clients. So we're very agnostic in terms of the products. Yes, we make money, we're relatively modest with our margins, but we're entirely agnostic as to what the solution is. It doesn't affect our profitability at all. So our focus is on delivering the right outcomes for investors. And why we use structured products is because of the precision. So we're able to put together products that deliver income or growth or capital protection or a combination of all of them to meet the needs of investors. What we find is it's the most efficient way to deliver those returns.
Okay, and how can the man in the street buy the structured note?
Yes, so there are a number of ways of accessing them. Traditionally, we work almost exclusively through financial advisors or wealth managers like yourself who can deliver the understanding and then explain to investors what the opportunity is for them. But more importantly, you're able to work with your clients and your investors and determine what their objectives are. So it's very easy for investors to say, look, what I want is 20% a year growth and I don't want any risk to capital. But in reality, that's obviously unfeasible. Interest rates in the Eurozone are kind of 2.5%, 3% a year. So actually, as soon as investors try and achieve returns over that, they're having to take some risk. So, to achieve higher returns, investors will be risking some of their capital or risking the chance of getting the return. So why we work with wealth managers is because we can work with them to determine exactly what their clients' requirements are. So, to translate what the client's attitude to risk is, how much of their capital they're investing, what they can afford to lose, and also what their objectives are.
Yes, and the client has to have a bank account or an account with an international life company or an account with a stockbroker who will be able to accept his instruction and buy the structured note.
Yes, and how we deliver them, and this is mostly to be as efficient as possible to keep the costs down, is effectively we deliver products what I think of as kind of factory gate price. So the products are manufactured by the various banks around the world, and we get that product to the investor as quickly as possible. So typically that will be through a private bank or some banking arrangement or another custody arrangement like an insurance company. And again, that's why we work with wealth managers, because they will understand the needs of the client, the jurisdiction they're operating in, and be able to find the right wrapper, if you want, or the right vehicle to hold the products we develop in.
So a client who has a bank account cannot just buy a Barclays product, for instance. He has to go through the procedure, not as a client. He can ask his bank if they have a custodian facility, and they can buy it. In the same way that if he has an insurance administration, he can ask the administration. What about the servicing of the structured notes? They are net of everything, net of charges. The client buys it as it is. It's only the charges of who is buying it that will affect the client. And the structured note simply works by itself. It has a system, it depends on indices, and it's making money on falling markets.
Yes, and I think that's an important thing. So although the mechanics behind the structured product can be quite complex, effectively an investor is just buying a bond from a bank, and instead of the bank saying we will pay you 3.5% per annum as interest, the bank says we will pay you 8% a year as long as the Euro Stoxx index doesn't drop by more than 50%. So the terms are set at outset. All the investor has to worry about is understanding what the returns will be in different circumstances, and then being comfortable with the credit risk, so the risk of the bank that's issuing them, maintaining their promise. Which is why, as you said, we work with around 50 different financial institutions around the world, most of them exceptionally strong. Very often they're what's known as globally systemically important banks. So after the Lehman Brothers issues in 2008, these banks will be supported by other central banks, by governments, by themselves. So we try and work with the safest banks. So as long as the bank still exists, the returns of the product will be delivered whatever the returns set out in the product are.
In fact, what is the status of a structured note in the balance sheet of a bank? If we take as an example the collapse of Credit Suisse, did people who had structured notes by Credit Suisse lose any money?
No, so the structured products we deliver will typically be what's known as senior unsecured debt. So they're very high in the pecking order. Even if a bank collapses, our investors will be very near the top in terms of having their benefits delivered. So the Credit Suisse issue, and again, this is an example of the modern banking system. If I was a shareholder of Credit Suisse, or certain types of the bonds, like the AT1s, the ones with equity-like risk, those investors got cleaned out.
Yes.
Personally, those investments would have been inappropriate for any of the clients we work with. But for some professional investors who held those assets, they were very unhappy with the way the merger with UBS was handled. From our perspective and from our clients' perspective, it was perfect. It was all done over the course of a weekend. Credit Suisse was in trouble. They were bailed out, with agreement of the Swiss government by UBS, and our investors received their returns, just like normal. So there was no particular disruption, no issues in terms of liquidity, and the products delivered exactly what they said they would.
So they are in fact safe to start with.
Yeah.
Safe as far as the issuer is concerned. Safe as much as possible as far as the system is working, because they are based on indices, and an index does not collapse, whereas an individual company can disappear. So we have volatility. Volatility is what we are after, I understand. And we are after, from start, to have a period of falling markets, falling indices, because it's when they come back to where they started, the indices, we get our cash back and the coupons.
Yeah.
So we are not worried if after 3 years of falling markets they came back and we simply got our money. We are getting our money plus the coupon. But there is a disadvantage, correct me. What if you are to buy directly a share? After 3 years, that share did not fall and come back to where it started, but it went up. And it may have gone up substantially. So there, the structured note is at a, call it, disadvantage in inverted commas. But is that a disadvantage? Because I understand this is how it works. They minimize the margin in which the return will be made. That's why you expect to get what you are saying, because you are not promising unbelievable returns that could come up from a rise in any share, but you are telling clients that you are making the risk as small as possible because you are operating in your expectations within certain limits.
Yeah, and that's a very good way of looking at it. If I take our viewers back to their mathematics classes in school, it's very much like an equation. So our investors, for example, would receive a maximum, maybe perhaps 8% per annum, and their capital is safe, even if the underlying markets drop. But if they drop by a certain point, they're exposed to the markets. On the other side of that equation, the bank will have the capital, and they'll earn some interest on the capital, 3 to 4% a year. The bank will also get any growth over and above the 8% a year if they hold those stocks. So it's almost like giving up something. So the bank will take the risk of markets going down. They take the benefit of growth over and above the returns we take. But for our investors, they're achieving the level of growth they require, but with the level of security as well. So it's almost like an equation, it's balanced.
Yes.
We give up the excess growth, we benefit from the capital protection, The other side, the bank benefits from the excess growth, but they lose out if if markets or the underlying stocks drop.
So in fact, you don't break the rule, but everybody knows that higher return means higher risk. You are skewing it to the benefit of the investor.
Yeah, exactly that. That's a very good way of looking at it. And that's probably the best way to describe structured products, is to imagine that, even if you imagine the number of likely outcomes from equity investing, you could lose almost all of your money, you could make 20% a year on the equities. All we do is reduce the number of outcomes to make sure the probability of the desired outcome is very high. We can, and we do for some investors. Some investors have very high growth requirements and they're looking for 20 or 30% a year returns. We can deliver 20 or 30% a year returns, but they come with quite a high probability of losing quite a lot of money. So, for most investors, at the moment, we target kind of maybe 2 to 3 times whatever interest rates are. So in that range, so in euros, that's kind of 5 to 10% a year. Returns in that range, we can deliver with a really low probability of clients losing money and a high probability of achieving those returns. So exactly as you say, the whole risk-reward equation, you can't break that, but we can just shape it. And this comes back to our point of what we try and do is deliver that equation in the best way for the investors we're working with. So yes, high returns come with high risk, low returns come with less risk, but just trying to hit that sweet spot, works. And as you say about falling markets, so our aim is to deliver those returns in all market conditions, other than, and ordinarily most of our products, if markets drop extremely low, investors, if they're low at the maturity of the product, they will be in line with the markets. So no, but many of our products, we see more products now where there's no probability of capital loss, but in return, the growth that's going to be achieved or the income will be slightly lower.
Yes. And how do you achieve the pricing of a structured note? What factors do you take into consideration? You go around various banks, you say, we want you to tell us how much do you give on this system using these indices. When do you do that? Do you choose the time? And do you know which banks need more of the money so that they will give you a higher return during that week? Do you know what your competitors are offering?
And this is, again, this comes back to the experience and the expertise. So the main component parts in the pricing of a product will be the level of interest rates, how volatile, how much the underlying index or the underlying stock moves up or down, and then combining those features to deliver the target return. So typically we'll have products on offer for 4 to 5 weeks, and we may have at any given time 40 to 50 different products available, offering income or growth or higher growth or capital protection. So we run with our own pricing models. We understand the market very well. And then because we work closely with the banks, we understand their demands. So typically, some banks might have a greater need for cash, and so they will be paying slightly higher returns. They need to attract more money. Other banks may have too much cash, they'll be paying low returns because they don't need so much capital. And then combine that with whatever the underlying index or indices are, or the underlying stocks. And even there, because we're so close to the market, we will understand which banks may have a position in a particular market and may be keen to offer products linked to that, and so we get better terms. But all of our products will be competitively priced. As I say, we have, it really doesn't matter to us which issuers we use, as long as they're the right credit risk. We're focused on delivering the right returns for the client. But even sometimes, during the course of a year, and this is where human nature comes in. So some banks might be pricing quite badly at the beginning of the year, and we don't place much business with them. But then come the end of the year, everyone wants to make their bonus, so suddenly their pricing gets a lot tighter, and we'll be using them more often. Other banks like to hit their targets and get the business in early in the year. So during the course of the year, typically we'll have live products with 5 to 10 different banks, but those 5 to 10 banks will change from time to time.
And are these banks, well, they are from Europe, definitely, they are from USA. I have seen you using Canadian banks, New Zealand, Australian. I have not seen you using Japanese banks.
We work with, we do some trades with Nomura and I think Mizuho.
Ah, correct, yes.
But often more on the fixed income side, so not so much with the structured products. We work with at least one Brazilian bank, for example. Now, in Latin America, it's a very big Brazilian bank. Investors in Latin America are very happy. They understand the bank, they understand the credit risk. Investors in Europe, sometimes a bit unnerved by, a Brazilian bank. So, yeah, we work with all the major European banks, US banks. I think most of the Canadian banks now, and then we have an operation in South Africa, so we work with some of the South African banks, some of the Japanese. And the reason behind that is just to deliver, the best pricing, the best products, and appropriate products. As I say, a Brazilian bank isn't going to be very reassuring for European investors, but for Latin American investors, they know the bank, they're very comfortable.
Yes, and in fact, in all these years that you are experiencing the creation of structured notes, you must have created not hundreds, but thousands. Probably, must be over 4,000 products, across different markets. And, as I say, when it comes to the risk, we have some clients who are very happy taking higher risks for higher returns as part of a portfolio. And we've had, I think about 4% of the products we've launched have lost money. Now, it seems harsh. I never have a problem with investors losing money. What I have a problem with is investors losing money when they didn't want to, or they didn't understand why, or they didn't expect to. So, if an investor buys, 5 products delivering 30% a year returns, and one of them loses money, well, I'm not too worried about that because the other 4 have, more than doubled, more than doubled their money. But for the core products, it's very rare. I can't think of any occasions where clients have lost money when we're the kind of, 5 to 10% range on the products. It's very, very unusual for clients to lose money or not achieve the returns. Would you like to touch on the 3 different types of structured notes you have? You have the classic auto call, you have the memory income, and then you have the fixed income for a shorter period.
Yeah.
So
the
classic auto call, what does it mean?
So the auto call is definitely my favourite product shape, and it works on a number of levels. It's actually quite a complex product for the bank to manage. Which I like because I think sometimes they price it wrong and they lose money on them. But for the investors, it's a very clean product. So a typical product, let's say it pays 8% per annum, it's linked to the Euro stocks. But the auto call feature means that it pays 8% for every year until maturity. So typically it would be 5 or 6 years until the product finishes. But the auto call feature means that if the Euro Stoxx index, for example, is above its certain level after 1 year or after 2 years or 3 years and so on, then the product pays the 8% for each year it's been in, and the investors reinvest. Now, why that works nicely and we get high returns, arguably the bank are very nervous. If the Euro Stoxx, for example, does really well, they're paying 8% for each year of the next 5 years. But by having the maturity feature, that means they're only paying the 8% for 1 year or for 2 years. If we did the same product without the auto call feature, the coupon might be 6%. So actually it gives investors the opportunity to earn a higher coupon, but the price, if you like, they pay for that is they may only be invested for 1 or 2 years, and then the product matures and the money's paid out. Now why I like that is you've got your 8% for the year or 16% for 2 years, and that you can reinvest that. but you've banked that as the investor, that's safe, it's back in cash, and you can decide what you want to do. So the auto calls are very popular, a very good growth product. And then we combine that feature to achieve a higher income on our income products. So typically, an income product linked to the Euro stocks, how we tend to structure them is that you still have the auto call feature. So if the Euro stocks is higher than its starting level, typically, i.e. no growth required, the product will mature, but income of perhaps 6% a year will be paid. And the income is paid as long as the index is above perhaps 80% of its starting level. So i.e. as long as it hasn't dropped by 20% or more, the income is paid. If in 1 year or one observation, it has dropped below that income barrier, then the next time it comes up, if it's back above it, we have what we call a memory feature. All the previous income is caught up. So, similar structure, but it pays out the income regularly, even when markets are low. So, if markets are down 10, 15%, the income's still paid. Those are the main products. The fixed income product, as the name implies, just pays the returns on a fixed level. So, for example, and we tend to do shorter term products, often linked to individual stocks rather than an index, paying again 5 to 10% income. That income is guaranteed, so the income is paid regardless, but then the capital is at risk at maturity. So after a year or after 3 years, whatever the term is, if the underlying stocks have dropped typically by 50% or more, so i.e. if they've halved, then investors keep the income, but their capital may be reduced. So those are the main products we tend to do, and sometimes we'll offer products with 100% capital protection, but the growth is variable. So you may get more or less growth, and it's as I always say, a combination of products. Some kind of diversification in the portfolio, but really it's matching client needs. If an investor puts all their money into a product and that's all the cash they've got, typically they need more protection or they need a capital protected product. But for most of our investors, the structured products will form a portion of their portfolio. So, the worst case scenario, if some capital is lost, it's not a disaster for investors.
Well, Clive, all nice things come to an end. Thank you for attending for a second time, coming from London to Kiamides Money Honey, a program that is designed to give information and is not designed to attract investments. Thank you very much for attending Kiamides Money Honey. It was a pleasure. Thank you very much. Thank you. The pleasure was all mine. And to the viewers out there, if you're seeing investment products and you don't understand the terms, it's not a good sign. Ask Mr. Kiamides because he will explain to you. Thank you very much for your time, and I'll see you again. Thank you. Thank you.